The 2025 Trump tariffs mark a significant shift in U.S. trade policy, reviving protectionist measures to bolster domestic industries and reduce trade imbalances. These tariffs, targeting key sectors such as technology, consumer goods, and industrial manufacturing, have triggered widespread debate among investors and analysts. While proponents argue they will strengthen domestic supply chains and protect American jobs, critics warn of rising costs, inflationary pressures, and retaliatory measures from trading partners. For equity investors, the implications of these tariffs extend far beyond simple supply chain adjustments. They influence corporate earnings, discount rates, inflation trends, and macroeconomic conditions, all of which play a central role in fundamental stock valuations. Companies relying significantly on imports will face margin compression, while others may benefit from reduced competition and government incentives. Furthermore, the tariffs introduce uncertainty that could heighten risk premiums, influence Federal Reserve policy, and disrupt global capital flows. Understanding the interaction between tariffs and fundamental valuation requires an in-depth analysis of their impact on corporate financials, interest rates, currency fluctuations, and broader economic conditions. This video explores these key dynamics and examines how investors should adjust their valuation frameworks in response. Tariffs function as taxes on imported goods, artificially raising costs relative to domestically produced alternatives. The primary objective of such measures is to incentivize local production and reduce trade deficits. However, they also introduce distortions that can ripple through the economy and financial markets. The 2025 Trump tariffs have been applied across a range of strategic industries, with particular emphasis on technology, higher levies on semiconductor components and electronics, automotive and industrial goods, tariffs on steel, aluminum, and machinery, consumer goods increased costs for apparel, household appliances, and retail goods. These tariffs can impact fundamental stock valuations through four primary channels. Corporate earnings and cash flows. Higher input costs can reduce profitability. Discount rates and interest rates. Tariffs may drive inflation, prompting a reaction from the Federal Reserve. Currency fluctuations. Trade policy shifts can affect foreign exchange markets, influencing multinational earnings. Investor sentiment and market volatility. Uncertainty regarding trade policies can drive equity risk premiums higher. To understand how tariffs affect valuations, it is critical to analyze each of these channels in depth. At the company level, the most immediate effect of tariffs is increased input costs. Many firms rely on global supply chains to source raw materials and intermediate goods. When tariffs raise the cost of these inputs, businesses must decide whether to absorb the additional expense or pass it on to consumers. Passing costs on to customers may not be feasible for companies operating in highly competitive industries. For example, retailers and consumer goods companies may struggle to maintain profit margins if price-sensitive consumers react negatively to higher prices. Technology firms, mainly those dependent on imported semiconductor components, may also find it challenging to offset rising costs without sacrificing demand. Some businesses may respond by restructuring their supply chains, shifting production to non-tariffed regions. While this could mitigate long-term damage, such transitions are often expensive and time-consuming, leading to near-term earnings disruptions. Thinking about sectors for a moment, I'd like to focus on three sectors where these impacts could be material. Technology. Higher costs for chips and components could pressure companies like Apple, Intel, and Nvidia, mainly if they cannot quickly diversify their supply chains. Consumer goods. Companies like Walmart and Target will face squeezed margins if they cannot raise prices on tariffed imports. Industrial manufacturing firms dependent on imported machinery and materials may see rising capital expenditures and lower net margins. Ultimately, reduced earnings and diminished free cash flows lead to downward revisions in fundamental valuations, particularly in sectors with high exposure to imported inputs. A less direct but equally significant consequence of tariffs is their impact on inflation and interest rates, which affect discount rates and valuation models. Tariffs increase the cost of imported goods, contributing to higher consumer prices and producer inflation. If inflation rises beyond expectations, the Federal Reserve may respond with tighter monetary policy, leading to higher interest rates, increased corporate borrowing costs, a higher discount rate for valuing future earnings. Rising interest rates reduce the present value of future cash flows, making growth-oriented stocks, especially in the technology and consumer discretionary sectors more vulnerable to valuation declines. Trade uncertainty also influences the equity risk premium, reflecting investors' required compensation for holding stocks over risk-free assets. Heightened geopolitical tensions and trade disputes tend to increase market volatility, leading to risk-averse behavior. This is particularly evident in industries directly affected by trade policies, such as export-driven manufacturing and multinational consumer brands. If the Federal Reserve adopts an aggressive stance in response to tariff-induced inflation, multiples across broad equity markets could be compressed, reinforcing downward pressure on stock valuations. Another key factor influencing fundamental valuations is the effect of tariffs on currency markets. The US dollar often reacts to trade policies in complex ways. In some cases, tariffs lead to dollar appreciation, particularly if global investors perceive the US as a safer investment destination amid trade disruptions. A stronger dollar can hurt multinational corporations as their foreign revenues become less valuable when converted back to US dollars. For example, companies such as McDonald's, Procter & Gamble, and Coca-Cola, which derive significant portions of revenue from international markets, could face FX headwinds that further erode earnings. On the other hand, if tariffs slow economic growth and widen the fiscal deficit, investors may become wary of US assets, leading to dollar depreciation. This could benefit exporters while exacerbating inflationary pressures, creating additional market uncertainty. Beyond individual firms, tariffs can have broad macroeconomic consequences that alter fundamental valuation dynamics. Slower GDP growth, tariffs can weigh on overall economic activity by increasing costs, discouraging trade, and reducing business investment. Trade retaliation. If key trading partners like China and the European Union impose retaliatory tariffs, US exporters may face diminished demand, further impacting corporate earnings. Shift towards deglobalization. Over time, persistent trade barriers may lead to increased reshoring and domestic investment, which could benefit specific industries and reduce global economic efficiency. In an environment where tariffs slow economic growth but simultaneously drive inflation, investors must navigate stagflation risks, which pressure earnings growth and valuation multiples. The 2025 Trump tariffs pose a crucial turning point for stock valuations, triggering a complex interaction between corporate earnings, discount rates, inflation, and macroeconomic stability. While some industries may benefit from protectionist policies, others struggle with higher costs, squeezed margins, and disrupted supply chains. The key takeaway for investors is that tariffs do not impact all companies equally. Careful assessment of sector-specific risks, monetary policy implications, and currency dynamics will be essential in identifying winners and losers. Understanding these interconnections will be crucial for navigating equity markets and making informed investment decisions as global trade tensions evolve.